While the retail public was focused on geopolitical tensions and the price charts, the real decision was made behind closed doors. Regulators quietly passed a new banking rule, and most people have no idea it even happened. This isn't a rumor, it is a regulatory mandate that goes into effect this week. And once it starts, the banking system will not operate the same way it did last week. They passed it quietly, because they know it changes everything. This is a fundamental shift in the engine room of the financial world. It changes how banks measure risk, how they hold assets, and ultimately, how secure the entire system really is. If you have a bank account, this affects you, because when the rules of banking change, the rules of money change with them. What the mainstream news isn't telling you is that this rule, while technical, is one of the most significant adjustments to the financial plumbing since 2008. Stay with me, because I'm going to break down exactly what this new rule is, what it means for the banks, and what it means for the safety of your money. Section 1. The problem. What just happened? So what is this rule that landed so quietly? It revolves around the Enhanced Supplementary Leverage Ratio, or ESLR. I know, it's financial jargon designed to be confusing, but understanding this is the key to understanding the new reality for our financial system. First, you have to understand who this rule applies to. It's not your local bank. This rule is aimed squarely at the giants, the 8 U.S. Global Systemically Important Banks, or GSIBs. These are the banks deemed too big to fail. JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, BNY Mellon, and State Street. These 8 institutions are so massive that their failure could trigger a global meltdown. Because of that, they are subject to stricter rules. To understand the change, you have to understand bank capital requirements. Before this, the rules were based on a brute force method. Imagine a simple, non-negotiable backstop that said a bank couldn't become too top-heavy, that it couldn't take on too much debt relative to its own equity. It was a fixed, rigid requirement, and as we're about to see, its rigidity was the root cause of a massive hidden problem in the most important market in the world. Section 2. The Old Rules. A system under stress. Under the old system, these 8 giants had to maintain an extra cushion of capital. It was a blunt instrument that treated all assets on their balance sheet as equally risky. And that's where the trouble started. For decades, this flawed logic was treated as good as gold. Starting now, that lie ends. The old ESLR rule punished the banks for holding the safest asset on planet Earth, U.S. Treasury bonds. A treasury is an IOU from the U.S. government, the ultimate risk-free asset. But the old rule treated a treasury as if it carried the same risk as a much shakier loan. This had a dangerous, unintended consequence. It forced the big banks to pull back from their role as market makers in the U.S. Treasury market. Why should you care? The Treasury market is the absolute bedrock of the entire global financial system. It's how the U.S. government funds itself. The interest rate on treasuries determines the rate on your mortgage, your car loan, your credit card. When the big banks pull back, the market becomes fragile and illiquid. It's like trying to run a city's water system through garden hoses. The entire thing can seize up. We saw terrifying glimpses of this in March of 2020. The very plumbing of our financial system was starting to clog because of this flawed, rigid rule. The regulators knew they had to do something before it caused a full-blown crisis. Section 3. The new rule. What exactly changed? This brings us to the rule that just went into effect. The Federal Reserve, the FDIC, and the OC jointly passed a final rule that overhauls this entire system. The official mandatory start date is April 1st, 2026, but they included a critical clause. Banks have the option to adopt it early, starting from January 1st, 2026. This is the Monday the title is talking about. The giants of Wall Street have been given the green light, and the market is forward-looking. The smart money is not waiting for the final deadline. They are positioning now. So what is the change? They threw out the old, rigid buffer. It's gone. In its place, they've introduced a smarter, risk-sensitive buffer. The new buffer is now equal to 50% of a bank's GSIB surcharge. In plain English, a GSIB surcharge is a risk score. The bigger and riskier the bank, the higher its surcharge. So the buffer is now directly tied to a bank's individual risk profile. It's tailored. It just makes sense. What does this mean for the bank's capital? According to the regulators, the overall level of capital in the system remains broadly unchanged. This isn't about letting banks go wild. For the giant holding companies, it's a tiny reduction in required capital, about $13 billion across all of them. But for their subsidiary banks, where the lending happens, the relief is much larger. That capital doesn't just vanish. It's still at the holding company level, but it unlocks it. It frees it up to be used to grease the wheels of the Treasury market and support the economy. This is a massive implication for everyone. Section 4. The Implications, Part 1. A more stable system? The number one goal of this rule change was to fix the plumbing. By making it less expensive for GSIBs to hold treasuries, the rule directly incentivizes them to step back into the treasury market. This adds stability to the most important financial market in the world and makes a 2020-style market seizure less likely. When the next crisis hits, and there is always a next crisis, the financial system's plumbing will be more robust. This is a huge win for financial stability. Naturally, the banking industry is thrilled. They said it would reduce bank funding costs and drive economic growth. Of course they would say that, but in this case, what's good for the big banks' balance sheets actually aligns with what's good for the system. But does this make the banks less safe? The regulators are adamant that it does not. They emphasize that the ESLR is just a backstop. The primary safety defenses are the risk-weighted capital requirements. This new rule simply aligns the backstop with the primary rules. Overall capital levels are not being cut. The capital is just being allocated more intelligently. The real source of bank safety for you has not changed. Section 5. The Implications, Part 2. What this means for you. So the plumbing is fixed and the banks are happy. How does this affect you? The biggest impact of this new rule is what it prevents. For the past year, a huge battle has raged in Washington over a broader set of regulations known as the Basel III Endgame. Those proposals were harsh. They sought to dramatically increase the capital banks needed to hold against various loans. And that's where the danger to you was. Under those proposals, banks would have been hit with a massive capital charge for the unused portion of your credit card line. The fear was that banks would respond by slashing credit limits for millions of Americans, choking off access to credit. Furthermore, the Basel III Endgame proposals threatened the housing market. They included provisions that would have made it more expensive for banks to write mortgages for borrowers with lower down payments. Banks would have been pushed to lend only to the wealthiest clients. This new ESLR rule is a major signal. By easing the leverage constraint, regulators have shown they are listening to concerns about economic harm. This rule change provides GSIBs with more capacity. It helps prevent the broad-based lending contraction that many feared was coming. So, the biggest news for you is the bullet we just dodged. This rule helps ensure your credit card limit isn't arbitrarily cut and that mortgages remain accessible. Section 6. The ripple effects, small banks, and the broader economy. While this rule is laser-focused on the 8 biggest banks, the ripple effects will be felt everywhere. It also has an impact on the thousands of smaller community and regional banks. While the giants were fighting over the ESLR, regulators have also been signaling tweaks for the little guys. There are proposals to adjust the community bank leverage ratio, CBLR, giving these banks more flexibility and breathing room to make the loans that fuel local economies. Loans to farmers, to small businesses, to projects in your town. When you put it all together, the message from regulators is clear. They are trying to promote economic growth. They are trying to ensure capital is available where it's needed, whether that's in the multi-trillion-dollar treasury market or for a loan to a new business on Main Street. By avoiding the credit-crushing mistakes of the harsher Basel proposals, this rule keeps the economic engine lubricated. Section 7. Your action plan. What to watch for next. So what should you do? This isn't a situation that requires you to panic. It's the opposite. This is about being informed. Here is your action plan. First, monitor your access to credit. The big takeaway is that the feared credit crunch from regulations has likely been averted. For now, you should not see a sudden tightening of credit card limits or mortgage availability because of this rule. If you do, it's more likely due to your personal credit situation or a broader recession, not this regulatory change. Second, understand the real source of bank safety. Do not let headlines about reduced capital scare you. As we've discussed, overall capital in the system isn't changing. The primary safety net for you as a depositor has not changed. Your deposits are protected by FDIC insurance up to $250,000, period. That remains the bedrock of consumer confidence. Third, and this is the most important part, watch what happens next with the other rules. This ESLR change was just one battle in a much larger war over the Basel III Endgame proposals. That is where the real fight is. While this rule was a win for common sense, the war isn't over. That outcome will have a far more direct impact on the cost and availability of loans down the road. This is the story to watch, and you can be sure we will be tracking it right here. Let's bring it all home. A technical but profoundly important banking rule just kicked into gear, changing the foundation of how the 8 too-big-to-fail banks operate. The new rule replaces a rigid, outdated requirement with a smarter one. Its primary goal is to fix the fragile plumbing of the U.S. Treasury market, making the entire system more stable. It does this without compromising the safety of the system. And most importantly for you, it helps us dodge the bullet of a credit card and mortgage crunch that many feared was coming from other harsher proposals. It keeps credit flowing, so when you hear whispers that regulators just passed a new rule, you won't be in the dark. You now know what it is, why it was passed, and what it truly means. The rules have changed. The paper game is over. The physical game has begun. Follow the money, not the rhetoric.